Comex has just quietly delisted a series of gold and silver contracts. No fanfare, no headlines, just gone. On the surface, they claim it's routine, a simple cleanup of low-interest products. But is it really that simple? Or is this move tied to the seismic shifts we've been seeing in the gold market? Record prices, a mass exodus of physical gold from London to New York, and whispers of a looming shortage. The real question is, what's Comex so afraid of? Are they bracing for something bigger? Let's take a look. Gold is so often the treasure being hunted in action movies, playing a supporting role in the drama. But in the last few months, it's like the real-life gold market has become the centre of the action, with all the intrigue of a blockbuster thriller. We've seen gold prices skyrocket past $3,000 an ounce, a massive exodus of physical gold from London to New York, and just this past week, Comex quietly cancelling a slew of contracts. It's like they're deleting embarrassing social media posts, hoping nobody notices. But we noticed. The question is, are these just routine market adjustments, or are the powers that be preparing for something far more significant, something they don't want us talking about? Does it mean the London vaults have been cleaned out? Let's start with the official narrative. Comex, the primary exchange for futures and options on metals, announced they're delisting several contracts tied to London gold. These include gold kilo futures, London spot gold futures, London silver spot futures, and cleared OTC London gold forwards. Their explanation? Essentially, there is no open interest in the contracts. Translation? Nobody was officially trading them. When GATA pushed them more, they were told by a CME Group spokeswoman that the lack of activity in the products led to the decision. Comex, like any exchange, periodically reviews and removes contracts. Low trading volumes, limited participation, redundant alternatives, or regulatory changes are typical reasons. Delisting simply means these contracts won't be traded or cleared through Comex anymore. Now, historically, the CME Group, which is Comex's parent company, has done this before. Back in 2010, they delisted E-mini gold and silver futures, along with some Asian precious metals futures. It was all part of streamlining their offerings, focusing on the more popular liquid contracts. Now, this recent delisting, they claim, is just more of the same. The delisting could have impacted market participants. Traders with positions in these contracts would have had to need to close them out or roll them into other contracts, potentially causing some short-term volatility. Companies using these contracts for hedging will need to find alternatives, maybe shifting to other gold and silver futures or different hedging strategies. The removal of these contracts might also reduce liquidity in specific market segments, potentially affecting price discovery and trading volumes. But the contracts impacted by Comex's decision include smaller gold kilo futures contracts, which are less frequently traded than the standard 100-ounce gold futures. And also affected are the London spot gold and silver futures, designed specifically to mirror the daily settlement prices of London's bullion market, offering investors exposure consistent with LBMA standards. Now, lastly, the cleared OTC London gold forwards were standardised contracts cleared by Comex, intended to bridge that gap between London's OTC market or over-the-counter markets and exchange derivatives. The abrupt removal of these bridge contracts certainly raises questions about the state of relations and the underlying health of the gold markets. So why is Comex suddenly distancing itself from London, the heart of the global gold market? And why now, when gold prices are hitting record highs? Because here's where I'm not totally convinced, because the timing is all just a bit convenient, isn't it? It's like a restaurant kitchen during a dinner rush. Chefs are scrambling, orders are flying, and the place is in chaos. But instead of focusing on getting the food out, the manager suddenly decides that now is the perfect time to reorganize the menu. Why now? Why in the middle of all of this madness? What are they really trying to hide or prepare for? Is this really just routine housekeeping, or is there something deeper going on beneath the surface? Now, officially, it looks like Comex are just doing this due to market simplification, low liquidity and redundancy. Low liquidity means higher administrative costs. And there are also plenty of highly liquid alternatives like standard Comex futures and LBMA OTC products. Removing these niche contracts also simplifies their regulatory compliance. And of course, with investors increasingly favouring direct bullion ownership, these contracts are supposedly becoming less relevant. Now, plausible explanations, sure. But the timing amidst this massive movement of gold from London to New York hints at a much deeper and potentially darker narrative. The immediate impacts of Comex's decision appear minimal, as major price discovery contracts such as the standard 100-ounce gold futures and the 5,000-ounce silver futures remain unaffected. However, specialised hedging strategies relying on the delisted contracts will need to adapt, potentially shifting towards other instruments or direct bullion holdings. And additionally, the OTC markets and the LBMA may well consolidate their focus around more traditional, highly liquid products. Most importantly, this move might signal deeper structural shifts in market preferences, possibly indicating a reduced appetite for paper gold contracts linked to London's market. Now, since December, we've witnessed a staggering migration of gold. A literal mountain of metal has been shipped across the Atlantic from London to New York. Industry insiders claim this unprecedented shift is due to fears of tariffs under a potential second Trump administration. And even though gold has historically been exempt from tariffs, traders supposedly aren't taking any chances. But let's be real for a moment. Tariffs on gold. It seems highly unlikely given gold's special status as a monetary asset, yet traders are spending millions of dollars enduring weeks of refining delays and clogging up airports to move this physical gold. Does this frantic activity really align with mere tariff anxiety? Or is there something else at play? Something like perhaps an unspoken shortage of actual physical gold in those London vaults, or a desire to restock a certain fort perhaps? And here's another clue, hidden in plain sight: Basel III regulations. Since early 2024, gold has been elevated to a zero risk asset under these new banking standards. In simple terms, physical gold has become crucial for banks needing to meet strict financial safety rules. And this has dramatically increased the demand for real gold bars, not these paper promises. Now, ask yourself this: if the demand for physical gold is skyrocketing globally, is it possible that Comex is worried about fulfilling its commitments? Could the sudden decision to stop offering London-linked contracts be less about lack of interest and more about avoiding the nightmare of physical gold shortages and delivery failures? So let's talk logistics, because this is where things have been getting really interesting. London primarily trades these hefty, big gold bars, and Comex, on the other hand, prefers the smaller, more manageable 100-ounce or kilo bars. And converting these larger bars is no simple task. It requires melting, refining, and recasting at specialised facilities, mostly in Switzerland. And this adds weeks of delays and substantial costs. So refineries like Argol Heraeus in Switzerland have called this entire situation a black swan event, completely transforming their cost structures and causing severe backlogs. Short-term gold borrowing rates in London, normally around 2-3%, spiked to around 10%, reflecting a severe shortage of readily available physical metal. And yet, despite these enormous obstacles and expenses, traders continue to move gold to New York. The official reason remains this fear of tariffs, but we have to question if this narrative is far too simplistic. Are market participants perhaps aware of more fundamental vulnerabilities within the gold trading infrastructure itself? If all this isn't intriguing enough, let's add another layer. Central banks are buying gold at record levels. Countries traditionally aligned with the US are quietly diversifying away from the dollar, adding tons of physical gold to their reserves. Rumours are swirling in Washington about possible gold revaluation strategies, add in the whispers of Bitcoin as a potential reserve asset, escalating geopolitical tensions, and increasing global debt burdens. And you can kind of see why governments and central banks might be quietly battening down the hatches. When central banks start stockpiling gold, it's not because they think everything's fine. It's because they're preparing for scenarios far more serious than most investors realise. Are you starting to see the bigger picture here? The broader economic and geopolitical context, including the movement of gold from London to New York, central banks buying gold, and potential global conflicts, suggest a shifting landscape in the precious metals market. The CME Group's decision to delist these contracts could be a proactive measure to adapt to these changes, focusing on contracts that align better with the current and future market dynamics. Issues in the London gold market could lead to a loss of confidence in the global precious metals market. By distancing themselves from contracts directly tied to London, the CME Group can maintain market confidence in their own operations. This move signals to investors and traders that the CME Group is taking steps to ensure the stability and integrity of their market, even in the face of potential crises elsewhere. And returning to Comex, it's clear their recent actions aren't just about housekeeping. By consolidating gold in New York and dropping problematic London-linked contracts, Comex is reducing its own risk exposure. They're not just simplifying operations, they're strategically positioning themselves to survive a potential physical shortage or market disruption. If traders worldwide are so anxious about physical delivery that they're willing to pay exorbitant costs to transport and refine gold, shouldn't individual investors be just as cautious? I've said it before and I'll say it again. This is not a drill. The gold market is clearly signaling something important. Paper contracts might have been good enough in stable times, but those times seem to be fading quickly. Governments are maneuvering, banks are accumulating, and global markets are growing more uncertain every day. If the smart money is busy ensuring they hold physical gold, investors who stick with paper promises risk being left empty-handed. Whether it's market manipulation, looming shortages, or hidden geopolitical moves, physical gold has never been more important, and it may not be this accessible forever, especially if governments consider drastic measures like gold-backed currency revaluation or further market intervention. Comex cancelling contracts and shifting gold from London to New York may seem technical or trivial, but you've got to ask, why now? What has been the catalyst to delisting these contracts? These moves are warning signs, indicators of deeper shifts beneath the surface. When central banks, governments, and major exchanges quietly move gold around like pieces on a chessboard and reduce the ways in which you can do this, then investors need to wake up and pay attention. The gold market may have once seemed calm and perhaps conservative on the surface, but underneath lies a world of growing intrigue, some risk, and therefore opportunity. Ignore these signals at your own risk. Our advice: follow the banks, follow the governments, and get yourself some physical gold. Let me know what you think. Hit subscribe, let us know in the comments below, and let's keep the conversation going.